Welcome to today's webinar. Many of you probably have seen the housekeeping slide at the front here, so we won't spend too much time to connect on this or to review it. Suffice it to say, though, if you do have questions, we will be monitoring those and collecting those and answering those at the end. So feel free to find the Q&A box and add it in there. But other than that, we'll get going here. So today's presentation or webinar is titled The Road to Change. And we really just want to examine the key themes that we're seeing in the energy transition. We being Enverus and the energy transition research team here at Enverus. You'll find today is a very molecule-centric presentation. The energy transition research team covers everything, though, from ESG, emissions management, carbon capture and storage, low carbon fuels, hydrogen, electrification, and power markets, power assets, et cetera. And we really find those topics come together to make up energy transition. But the focus today, like I said, is a little bit more molecule-centered. The second thing I'll point out, too, is we're planning to do this type of presentation or webinar 3 times a year. So roughly now in the fall, ahead of sort of that busy fall push. A second event just after Christmas here, as we all get back from the holidays and think about what the year should look like, will look like, and get started on the right foot. And a third time, probably late spring, as we've had a chance to kind of absorb the new year and think about what the rest of the year might look like as we go into summer and so that quieter period then. So look for future iterations of this, and we hope this is useful and helpful for all of you. By way of introduction, my name is Ian Niebuhr. I head up the energy transition research team here at Enverus, and that covers a range of topics that I described a minute ago. And with me is Morgan Kwan, and I'll let Morgan introduce herself as well.
Hi, everyone. Yeah, thanks again. I've joined the energy transition team just a few months ago, but have been with the company for upwards of 7 years, primarily on the oil and gas side. So definitely coming at this from a lens from more of an upstream molecule-focused viewpoint, but yeah, definitely exciting space to be exploring. So I think to kick it off, we want to keep this somewhat interactive, maybe a little bit more on the casual side. So definitely plop in your questions in that question box as we move through this. We do have a number of these poll questions scattered throughout, just looking to see, where everyone's coming at this. Everyone has a different viewpoint, different set of skills and capabilities, which we're going to get to in this presentation later on. But yeah, really looking for your input. So this first question, I'll give you 15, 20 more seconds to answer this, but it's, what does your energy transition strategy look like?
And you can vote, I think, Morgan, just by clicking on the screen, I believe.
Yeah.
Perfect. All right, we'll give folks 1 or 2 more seconds here to pick a strategy.
Or not.
Or not.
That's fine too. I should say that's an option too.
Yeah, we'll come to that, I think, through the presentation here. All right, I think we got a handful of results. I mean, feel free to keep voting, but I'll flip to the results slide here, and I think we'll get a little feel for where everyone's at. So it's kind of an interesting mix here, right? We've got everything from no perceived strategy, maybe just watching. We hear that a lot, I think, from the clients that we speak to and the participants we talk to. A few people overwhelmed by options. Maybe those two are kind of similar in a lot of cases. I think many of us are optimistic that there are ways to participate, and we'll spend some time today talking about how. But interesting to see, like, at least amongst this group here, not a lot of really active or proactive energy transition strategies. And I think that's okay, but we're hoping to leave you today with some reasons why maybe that is a position that we want to keep moving away from, or some of the implied risks or consequences of taking that or being in that place today. So, we talked about energy transition here. I think it's really important to define what it means to say energy transition. Everyone we speak to has a little different definition. And so for clarity, the way we think about it is really a set of observed outcomes or consequences of 4 major forces that are shaping the way that the energy industry works together. And so that's what this slide here is meant to illustrate. And the way we frame it up is just looking on that x-axis, there is a continuum from values-based incentives, so those things that we kind of feel emotively or morally or ethically, all the way to financial incentives, hard dollars and cents, and what do the numbers say. And then on the y-axis, we see this a range of preferences of what do we want as individuals, but also how do those things aggregate up at the societal level. And as you walk around the 4 quadrants here, you see things like in the bottom left corner, the consumer-led preference. We observe this sort of electrification theme, or the preference as consumers to consume our energy in the form of electrons versus heat. We're all working on laptops today. It wasn't that long ago you could get like a fuel cell battery pack, I think, for your laptop, or I vaguely remember that in university. That's kind of unheard of today. Like, we're all plugging that in. Batteries are sort of the standard. And I think you see that whether it's consumer electronics, electric vehicles, and many other parts of the consumer landscape. On the bottom right, you see a shift in the microeconomic landscape. So that's sort of changing economics of different technologies. We all have heard about how renewables, particularly solar and wind, have come down in cost over the last number of years. I think we all see commodity prices today also moving up, supply chain challenges. Suffice it to say, there are ever more substitutes across the energy landscape for investment, and the order of those potential opportunities on an economic basis is also getting resorted and changed period by period, year after year. So a lot of change there, and frankly, a flattening of the curve in a lot of cases. In the top right, we think about investors. I think over the last 24, 36 months, the investor class has certainly really stepped into the environmental or climate awareness side of the investment landscape. How and where they incorporate ESG into their decision-making process certainly varies a great deal. But the vast majority of capital today, in some way, shape, or form, is considering climate-related risks, either directly in the investment thesis or potentially as a longer-term risk to the businesses that they're investing in. So even if it's not like an explicit mandate, it's still showing up in the thinking and the decision process that they're all undertaking. And then the last place is probably the place that's been the most pronounced in the headlines over the last, call it 18 months here, this massive shift in political and regulatory policy and support. In the US, you hear things like the Inflation Reduction Act, but even components of the CHIPS Act, Infrastructure Act, certainly coming through. On the back end of that, we're seeing a big shift in terms of policy, whether it be FERC regulations, EPA, other standards. So, lots of things happening in the political arena that are serving to either influence or accelerate some of the changes that we're seeing in place. So when you put this together, the way we think of it is like, these are the forces. What it looks like on the other side really is independent or individually specific and technology specific, but all those changes we encapsulate into the term energy transition. From a point of view standpoint, we also think that really participation is not optional, and whether we like it or not, many of us are already participating. So this top ring is talking about some of those bigger shifts in the marketplace. I call them more sticks, if you will, that are coming in. I mentioned some of the EPA programs, like the super emitter program, proposed changes to subpart W, big movements, right? Or coalitions of emitters like the Pathways Alliance here in Canada. There is participation in a large number of ways, some voluntary, some not. The other side of it, though, is there's also trillions of dollars of incentives available to drive investment. So even if you're not strongly aligned with the direction of travel from a societal perspective, there is a river of money out there as well that folks are looking to try and capture and take advantage of it in the course of their business. And when we say thrive, we really mean your business thriving, individuals thriving, and the communities that we live in and work in thriving. And so all those things actually have to come together. So with this backdrop, I think it leaves us all to a question of, even if we don't have a strategy today, what does success in this energy transition really look like for you? And I think getting to that sort of fundamental question is critical. And we'll spend the rest of the presentation talking about some of the things we're seeing that are driving that. Now, as you contemplate that, we'll ask you a separate question is like, what will motivate energy transition strategies more? And so another polling question here, and it's sort of the range of questions from policy and regulations, that social license piece, shareholders and investors, nothing, I'm on the sidelines, I'm happy with that, or is it something else? So curious where y'all where you see the motivation coming from. I don't know, Mario, where would you, not to color the voting too much, but where do you sit on this?
Yeah, but it's not going to, I think it's a split. Definitely policy and regulations we've seen, especially with the EPA revisions, play a strong hand in this. But
yeah, I tend to default to shareholder value. I think all this stuff kind of comes together to ultimately be good for business and driving the economics and the value proposition of businesses. All right, let's see what the polling results look like, and then I'll hand it off to you here, Morgs.
Look at that,
50-50.
Even split. Nice. Awesome. So yeah, to think through kind of how should someone look at an energy transition strategy, the team kind of put together this framework, or a bit of a thought experiment, if you will. But the first thing we considered is, at the bare minimum, an acceptance or understanding that the energy transition is a real force happening in the energy market today. And the way we think about that is, and if you think of it as levels of conviction. So if you start out at the aware bucket, this is kind of where that policy and regulation forceful hand comes into play. So kind of as an operator or a participant in the energy industry, you're aware of the policies or the necessary regulations you need to follow to kind of pursue your business. And whether these change as the energy transition moves along, so will your business. The next step would be more of an adaptive level of conviction. So you're seeking out opportunities within the energy transition space, but they're mostly opportunities that align with your current skill set, asset set, your current business model. So not stepping too far outside of that comfort zone or capability sphere. And then the third level and the highest level of conviction is what we would call the adoptive sphere. And these are really companies that are striving to actively participate in the energy transition, despite whether it's acquiring a new business set or a new revenue stream, looking to develop different skill sets or acquire different infrastructure in their current business model. So depending on kind of your level of conviction in the energy transition, I think really determines how far you jump into an energy transition strategy. And the way we think about, once you figure out, how far you want to jump or how deep you want to jump, another way to think about it is context, capability, and then that conviction level. So context is really referring to a company's existing access to infrastructure, production of necessary resources, or other geographical and regional characteristics. So for example, an upstream operator, CCUS lends itself relatively well. But for a midstream operator, CCUS probably aligns a lot more closely in terms of context, just because of the transportation of molecules using very similar assets. Another example would be DLE, taking produced water with lithium concentrations and extracting that for lithium product. Again, aligns somewhat pretty well with upstream operator, as well as oil field services, just through drilling other DLE access points. So that's one way we think about context. It's mainly just how it aligns with your existing business and a energy transition technology. The second piece we consider is capabilities. So taking into consideration the adjacent expertise or your current assets. And like I said before in those examples, this could include geological and technical capabilities in reservoir analysis or drilling. Just a few examples there. But I think what's important here through the capability is to recognize the scalability especially with the energy transition technology. So does your infrastructure and skill set today offer you a competitive advantage to scale into that energy transition technology? And then it all boils down back to the conviction level. So your participation in the energy transition extends beyond just social license, and through the poll questions and through conversations with Ian and the team, we really think that it's ultimately driven by financial returns. So is this a good business decision? And that ultimately will take a high level of conviction in no matter what strategy you decide. Any waffling, and we've seen this examples in the market today, that companies that have waffled between either strategies or acquisitions in certain assets don't fare well, whether it's energy transition or not. The last piece in this thought experiment or framework that I'd like to leave you with is an analogy to the slight edge. So just a little bit background. When we first joined the company, our president and CEO at the time, presented everyone with this book, The Slight Edge. And in it, the author, Jeff Olson, he talks about the power of making small daily changes. And over time, these lead to success. Or on the flip side, if the compounding of simple errors in judgment over time lead to an unfavorable outcome. So it's kind of similar to where we are in this energy transition today. Implementing small changes can be uncomfortable now, but over time, they become more normal and accepted. And so while it's easy today to keep doing what you're doing and try to keep your business model the same, over time, especially as we get further and further away from where we initially wanted to be, things like policy, regulation, they'll just drive that gap even further. So, of course, the book uses examples like losing weight or working towards a healthier lifestyle. But if we keep this slight edge kind of framework or as an analog to the need to implement an energy transition today, because if you don't start making small steps today, the policy and regulation piece especially is going to catch up with you in the, I guess, with the EPA revisions this week. It's coming a lot faster than what maybe some folks initially thought. So with that, I'll hand it over to Ian to kind of take a look at that specific.
Yeah, no, I love that slight edge mentality. And I think it's really the point is that, we might be early stages and it's relatively small differences in performance or difficult to perceive differences in performance today when we look at the equities. But we certainly see a trend where that gap will widen out. And so the need to develop those capabilities and be proactive around that is going to be increasingly paramount. And a great example is this sort of policy and regulation piece here. I'm not going to read through every piece of it. We got an entire report digging through all the points. I think there's just a couple things to stand out there. Like the degree and sophistication and complexity of the policy and regulations coming at the industry is exploding. And so that has a couple consequences. One is just the raw expertise on a policy and regulatory side to understand and navigate, just so you can appropriately report and capture and manage the data standards around what is being asked of the industry. That's a big step change. And I think we've seen numerous different sources talk about energy transition and emissions being a catalyst for digital transformation. You don't have to look too far into these sort of data sets or these sort of regulations to understand why that policy really does demand sort of a next step in terms of information technology, infrastructure, and capabilities. And that's not something you get to just sort of like lackadaisically follow along with. I think it's something that increasingly one has to be proactive and on top of like, where is this headed and how do we prepare our systems for the future? Because this is likely not the last step. It's really just the next step of many. But anyway, lots of O's, Quad O, Quad OEB, C, changes in sort of the methane tax and sort of Subpart W reporting standards, which we'll touch on in a second here. So speaking of Subpart W, and this is, again, a great example of change in policy and regulation representing material impact. And so what we're showing here is there's proposed regulations to change the way that methane is reported into the EPA. And so this is not a fundamental change on the ground of how many molecules are being released. It's not a fundamental change of how folks are operating their business. It's simply a change in reporting standard and the accounting in which that is done under. And the difference and the consequence is if we take 2021 reported methane emissions under the existing rules and then recalculate everything across the lower 48 under the new or proposed rules, you have a near doubling or more than a doubling of the reported methane emissions for the industry. All right, so just a change in accounting, just a change in policy dramatically changed the appearance and the observed performance of the industry. Now, there's a number of different categories that are particularly large. You can think about super emitters. We can think about equipment leaks. We can think about combustion slip, flaring efficiency metrics. These are all sort of material changes. But in each and every one of these categories, there's either a subtle or a significant change in the reporting standard. And there's a difference in behavior, I think, that drives in how we think about running our business and managing and coping with these regulations and policies. We can make this a little bit more real. There's the methane tax for high emissions or high methane releases here. The consequences for upstream operators is shown here on the left. Instead of about a third of volumes being exposed or potentially exposed to that methane tax, you're now well over half. Now, this is under current operations. We know there's a ton of operators out there working really hard to improve their performance, and it won't be what it looks like when these regs come like full-fledged into force. But the point is the exposure is much higher, and so the demands are much higher and something to think about in your business. On the right-hand side, we're looking at gathering and midstream. We go again from about a third of moved volumes being exposed to that methane tax to effectively all under this math. We know there's lots of work being done to improve it, but again, from a business exposure and a risk standpoint, this is something to pay attention to. And again, it's just an accounting change. We can also talk just about like methane leaks from equipment here. And in this case, we're just trying to look at the materiality at a basin level, but we certainly could look at this from an operator level as well. But huge changes depending on where you are and what reporting standard you've been working under. You know, places like Appalachia have benefited from some of the regulations, and the proposed changes could represent a tenfold or more increase in the reported emissions. Places like the Permian, you know, not as dramatic, big emitter, but not as dramatic in terms of percentage changes, but it's still, you know, 150% or more increase in terms of proposed emissions or reported emissions. So lots happening. Doesn't mean you have to change who you are as an E&P company, but the ability to cope with and manage these regulations and reporting standards is a capability that we all have to develop, and it's not going to suffice to kind of stay with the status quo. So this is kind of the awareness phase, as Morgan alluded to. I think the other one that we talk about a lot and see a lot of businesses shifting towards is like, how can they adapt their business? Where do they have that native capability? And a really good example of that is carbon capture and storage. We've seen an absolute explosion in the number of projects out there. In this particular case, we're just trying to lay out by business or by company the list of projects that we capture in our data sets. You can see some like Oxy, like Shell, like Synovus at the sort of the upper end, huge volumes of CCUS proposed in their project slate, very North American dominated as shown in orange, but other parts of the world too are pretty active. You know, Europe's a big one. There's a lot of different policy and pressure to get there. And then other parts of the world, a little less pronounced, where either the geology doesn't line up, the policy doesn't line up, or the incentives don't line up to make this work well. So just a good example that, you know, once you get past the raw emissions management side, there's another leg, carbon capture and storage being one, where that emission is actually the commercial feedstock for a brand new business or for an evolving business model like carbon capture and storage. So we're going to pause and take another poll here. And, you know, when you think about the range of technologies, there's a whole range of hype around those technologies that are available. So the question here is like, what do you think is most overhyped today? Is it biofuels, hydrogen, advanced nuclear reactors, SMRs and the like? Is it wind technology? We can think both offshore and onshore. I know those dynamics are subtly different. Solar, where's the hype? Oh, Where are you voting, Morgan?
I don't know. I feel like there was a lot of hype around wind, and it experienced a lot of momentum, and now it's kind of got to the point where policy and regulations are actually a major headwind for it.
Yeah, particularly in the offshore arena.
Mm-hmm.
Well, we got a good swath of answers here. Let's see what everyone else thinks. Ooh, hydrogen.
Interesting. Like it.
All right, I'll pass it here to you, Morgan.
Yeah, okay, I'll do this last one and then I'll dive in. We'll start to dive into some of these technologies. So what do you think is the most overhyped technology for reducing emissions? So whether that's CCUS, hydrogen long duration batteries, direct air capture. Give you a couple seconds here. It's kind of bucketed into two camps. There's technologies that replace our hydrocarbons as fuels, and then technologies that reduce the emissions of our.
Yeah, that's an important difference, eh? Because, and we get to this maybe later, but the range of jurisdictions, some places really focus on emissions reduction as the priority, and others focus on accelerating the adoption of energy transition technologies, not necessarily with the first priority being reducing emissions. All right, well, let's see where people landed. Oh, hydrogen hype curve.
Yeah, both sides. Okay, interesting. Thanks for entertaining us with these polls. So, yeah. Ian kind of mentioned that CCUS, if you're in that adaptive phase, so you've moved on from, being aware of policies, regulations, a need to adapt somewhat. The next would be adapt. We've seen a lot of companies move into the CCUS space just because it is a more natural fit to current capabilities and assets. But if that's not your cup of tea, or it's not in the cards for your company or strategy, what other technologies are out there for participating? And so just to reemphasize, we use the term energy transition as a broad, sweeping term, but really we're trying to capture any movement away from hydrocarbons. And so our ETR team, we focus on technologies that are attracting capital flows, investor interests, and are set to make a meaningful impact on the primary energy mix. And so while we mentioned it at the beginning, it's easy to be overwhelmed with the number of things that are being labeled with energy transition. These are the primary areas that our team is focusing on. So when we look at them, we simplify it on two scales. One is that, do they impact the hydrocarbon molecule, or are they part of the electrification movement? So that's on the x-axis here. And then the second piece is, how adjacent is the technology to your current business asset and capabilities? So this chart here, it's set up for an upstream operator. We just did a report on the ways to play for an upstream operator. So this is where it's taken from. So it'll change depending on what segment or where you sit in the energy industry. But for an upstream operator, if you're sitting further up the upper left-hand side, it's somewhat obvious, or a lot clearer, that why these technologies would be more adjacent to your assets, given that they're molecule related, versus the electron focused assets like renewables, nuclear reactors, how those would be much less adjacent to an upstream operator. Now, it's when we think about it that way, adjacency, it makes sense that when we look at the M&A activity recently, that it's mostly upstream operators transacting on things like CCUS assets. We saw Exxon accelerate their energy transition strategy with the acquisition of Denbury, $4.9 billion acquisition there. Oxy has been making a lot of moves with their energy transition subsidiary, most recently acquiring Carbon Engineering, another CCUS or direct air capture type technology there, again, over $1 billion. And then we also saw the French multinational company Engie acquire a battery storage asset out of Houston, Broadreach Power, for over $1 billion. So that's a little bit less adjacent or on the molecule side, but still, nonetheless, we do see a handful of operators, choosing to acquire the context and capabilities that they didn't naturally have in their upstream business, just to be able to accelerate that energy transition strategy, which starts to beg the question is, at what price is it worth paying to accelerate that transition strategy? So this chart here is just looking at the energy transition M&A market through time. So this is a report that our M&A team puts out every quarter. We've done it for a while now on the oil and gas side, and we've just kicked it off for the energy transition side. And this is really leveraging our energy transition M&A platform in Prism. So we actually capture over 5,000 deals across 100 companies. And this is spanning power, both generation, distribution, storage, integrated assets, plus alternative fuels, CCUS, equipment manufacturing, EVs, and mining. So the M&A database that we're pulling this data from is pretty extensive. But yeah, two things that I really wanted to highlight here is that the energy transition M&A totaled $36 billion in the last quarter. Now, while this is up about 35% quarter over quarter, it is down about 10%. Power deals are dominating this M&A market, but they did slow partially compared to the second half of 2022, but this was offset by an increase in mining. And really what's driving this is the lithium deals. So as the need or the demand for electric vehicles increases, the demand for lithium for those batteries is really taking off. So again, this lends itself into DLE, interest in DLE technologies and companies has really increased within the last year or so. The one thing that was a little bit surprising is alternative fuel deals kind of sputtered out between the first and second quarter of 2023. But we do still see this alternative fuel market as an attractive choice, especially for legacy energy operators. But yeah, definitely the M&A market in the energy transition space has been pretty strong, and we only expect that to increase, especially as we see some of these energy technologies mature. So here, this chart is just looking at deal count through time, split out by just the different categories. So the more mature technologies or categories, you think power, so generation, distribution, or integrated, they're on the upper end of the scale. As well as mining. So if we kind of think of those as analogs for technologies in the M&A market for mature technologies, this is kind of where we would expect to see activity for CCUS, storage, alternative fuels to grow into as those technologies and assets mature. So the point here is that, even though there's maybe not as many deals happening compared to your traditional oil and gas, the space for growth, especially as they come up the maturity curve, it is huge. Here, I just wanted to point out that in terms of cumulative volume, power, like I said before, is the main component of that. But within the generation assets, wind and solar make up about 50% of that. The remaining 50% are multiple generation types where buyers are just looking to diversify or decrease their exposure risk. But yeah, just wanted to point out here that while power right now dominates, I guess, the cumulative value of these deals, things like geothermal, alternative fuels still have a huge amount to grow. But where it starts to become interesting, and maybe we get a lot of pushback, and you'll have a poll coming up after this, just curious to see where everyone stands on this, is, how big is too big of a premium to pay to accelerate this energy transition strategy? So even though there's maybe not as many opportunities as what people are more familiar with in the traditional oil and gas space, because there are a limited number of assets and opportunities available, we're really just seeing the big players take advantage of these assets, locking up these strategic assets to accelerate their energy transition strategies. So if the option is either to grow and build it organically or acquire it, what we're seeing right now is many are choosing to acquire it. So on the high end here of EBITDA multiples, alternative fuels, and then those power deals definitely make up the upper end of that. And then CCUS and mining are maybe a little bit more down in the realm of traditional oil and gas compared to the chart on the right-hand side here, but still quite a bit higher. So people are paying to lock up these strategic assets. So with that, I'll lead us into one of our last poll questions here. Are you surprised by the multiples companies are paying to accelerate their energy transition? Whether maybe they should be higher, or you agree they should be lower, or curious to see where people stand on this.
Yeah, there's some rich numbers out there. It really speaks to the need for conviction, right? And having clarity in your purpose and where you want to head to be able to participate in markets that are trading in that way. Should we see where we're at? So it's a pretty neutral set of response, maybe a little bit to the lower side. I think it'd be fun to unpack that with some of you at another date. I think, we would probably be a bit in the nuance camp in a lot of ways where it can make sense, but it's got to fit into a much larger scheme of why that specific asset capability context is important to your go-forward strategy. If it's just acquisition for acquisition's sake, it's a much more challenging number to go get. So where does this lead us? If you haven't noticed, I think a lot of our thesis here is it's time to get off the fence. And what we mean by that is the need for being proactive wherever on that spectrum you want to be. It's fine to be a classic E&P company. It's fine to be a pure energy transition business. That clarity of purpose and building the capabilities and the organization around that strategy is where we're really, I think, pushing folks to get to, because the consequences of not building in that direction, whatever direction you choose, only become more pronounced as you see that sort of slight edge type of framework take place. Now, this is all happening in a world where we see, we'll call it a technology horse race. We talked a little bit about carbon capture and storage, which is, I think, even in the polls here, sort of the lowest risk, least hype technology that we touched on. But there's others like direct lithium extraction or geothermal that are, I think, something we get a lot of questions on, but they kind of surge back and forth between headlines and day to day where folks are focused. Maybe today DLE is a little bit ahead with some of the bigger transactions that you can see in the M&A data. Carbon innovation or capture technologies, it's increasingly clear that while pore space probably has some of the greatest embedded risk that in a way that we would understand from an E&P perspective, having access to a high purity emission stream, being able to capture CO2 at an efficient and low cost way is going to be one of those big strategic differentiators. And that's certainly a point of view that I think companies like Oxy have with their recent acquisition. So we'll look to see how that unfolds. There's a lot of uncertainty on the technology side as well, but it's a place where I think a lot more focus is showing up. Power assets, again, deliberately less power focused today, but there are some great examples of how those markets are transforming. Some of the recent work we've done in CAISO and ERCOT and others shows and maybe gives you a bit of a preview of where those markets are headed and what the emergence of a really large renewable or weather-dependent fleet might mean for those systems and the opportunities that creates. And then lastly, energy markets, going back to the electrification side, we spent a lot of time talking about power burn and sort of like what is the gas impact into power and how that market's evolving. But also in this case, the emphasis on regulation and policy as we get more clarity around how these policies will be applied and sort of get final metrics there. So lots to pay attention to, but those are probably like the four big baskets of what we think are going to be particularly dominant in the narrative over the next quarter or two. So just before we close, maybe we'll do a final question here, which is if solar and wind have crossed the finish line and CCUS is out front, who's this close second? Like where I kind of gave away where we thought, but be interested to see what this group thinks about the next wave of technologies that really are viable opportunities, in energy transition, if one were to pursue something outside the traditional energy space. I think this is a hard one. It's probably going to be more reflective of the people answering and their unique context and capabilities, not to preach the Fairmic too much, but we'll give you 2 more minutes, or not 2 more minutes, 10 more seconds. That'd be a long silence.
Yeah.
Let's see. Ooh, geothermal, a little nuclear, a little DLE.
It's interesting that a lot of people voted hydrogen as overhyped technology, but there was.
It does seem to be a pretty divisive technology.
Yeah.
Just anecdotally.
Great.
Well, lots to unpack there, and we think there's going to be some great opportunities across all of these. There's also going to be some huge pitfalls as well. So just a final plug here, right? As a team, we do spend a lot of time trying to understand all of those specific technologies and how they might jigsaw together for specific businesses or specific opportunity sets. These slides, I think, will be made available after the call here. All of these are sort of headline reports that you can get access to if you want to kind of dig into the undersurface knowledge or work we're doing in some of these issues. But just want to highlight this and let people know that the team's here and sort of engaged across the spectrum of energy transition in the service of our clients. So with that, I'll close and say thank you for attending. If you enjoyed today and you want to stay in touch with some of the content we're putting together, there's a free newsletter called Energy Transition Today. Feel free to sign up for that. We're not going to go spam you, but once a week you get a newsletter that kind of highlights one of the issues or topics that we think is particularly notable. You can also follow us on LinkedIn. If you do want to get a little closer to the team and spend more time talking to us and understand how we can work together, there's certainly an email address here to connect with, and I'm sure we'll be happy to get in touch and schedule a call or a meeting. And for those clients on the call as well, a couple research notes that we've put out. There's obviously a long list of them on the prior slide, but 3 that really stand out to us. One was the ways to play, which unpacks more what Morgan talked about, the strategies that various operators are employing, the different criteria they're using to come up with that strategy. But there's also a whole host of really good links into the rest of the body of content if that's something that you're interested in exploring further. The EPA emissions revisions, or that subpart W revisions, super complex and detailed amount of analysis there. Well worth a read if you're not familiar. If you are familiar, I'm sure it'll be helpful. If you aren't, it might be slightly terrifying. It was to me, at least. And then last, the M&A stuff. It's always neat to see what's happening in the space here, and at the very least, keep a finger on the pulse and sort of the most tangible types of of steps that some of your peers and competitors are making. And we do have a couple questions, I think, in the chat here. Feel free to add a couple more. But I guess, one for you, Morgan, just thinking about we got to do the obligatory compliance slide. But one more, as you think about M&A, I think you mentioned that we think that we're going to see more deals in some of these new technologies down the road. Why do we think that?
Yeah, the main reason, I think the main motivating factor is when, as companies are looking at forming these energy transition strategies, you can start to identify which technologies make sense from an adjacency perspective, like does it bolt on to their revenue stream or existing assets? And then the question becomes, do you build it organically, or is there a company out there kind of building into this technology that's matured it to a point where it makes sense to just acquire it? And so the acquisitions that we've seen to date have been companies doing just that. They've been acquiring these mature assets or technologies. And I just think as technologies like DLE, geothermal, as they move up the maturity curve, you'll probably see more and more, traditional oil and gas companies move to acquire that into their energy transition strategy.
Yeah, I guess even thinking from a power standpoint, the other thing that I would observe is if you think about wind and solar assets, part of the reason we're seeing more transactions now is they're just more mature. And so these organically constructed portfolios or subset of portfolios are now at a scale where they are marketable and being transacted in a public market setting. And we just haven't seen some of these organic investments show up. So I wouldn't let the relatively few number of transactions observed in the data set today be a marker of lack of investment. It's very dilute in a lot of cases and in a handful of concentrated portfolios. Other one that jumped out here, I guess it was more of a comment from someone on the call here, but just there's differences in strategies across locations and geographies. I've got a few comments for that, but Morgan, I'm not sure if you want to share anything or have any ideas off the top.
Yeah, it makes sense, especially if policy is one of the initial forces of movement. Depending on where you are, U.S. versus Canada is a great example. We get a lot of pushback or conversation around emissions reporting and how different it is between the U.S. and Canada, and that alone has created a lot of different approaches towards the need for an energy transition strategy in itself.
Yeah, it's a great point. I think from a macro lens, we talk about, or you hear, I like frameworks, so I'm going to use another framework, but things like the energy trilemma, right? Of how do you get affordable, sustainable, and secure energy into the energy mix? And it's always a balance of those three big criteria. And as you move to different regions of the world, I think we observe policy that reflects a different balance of that equation. As you go to Europe, sustainability certainly takes a much stronger priority in the policy and the rhetoric and the sort of the social sentiment. I think, Morgan, even as you described, like even Canada, US, there's some subtleties in that. You go to Asia, security in many of those countries is a much higher priority. And so you see a different set of priorities. Maybe it's security from an economic lens, the Korea, Japan, maintaining access to export markets, security of just raw supply for more rapidly developing countries. And then North America, a different flavor and balance of those things. So I think it's a great call out that, there's some hyper local differences in priorities and how that manifests itself. And, even if you get the technology right, the opportunity might be very different depending where you're located. Well, I think that's what we've got for questions. We certainly appreciate everybody taking the time to join us this morning. If there are other questions, please don't hesitate to reach out. We'd be happy to answer them when we can, or as soon as we get off the call here. So thank you again for the time and the interest and your attention. And we'll close the webinar off here.